Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking sanctions on Russia, their impact on the global commodities markets, what this means for deglobalization more broadly, and how can the commodity trading sector manage these risks and navigate what is an increasingly complex global landscape. Guiding us through this new world of geopolitical risk is George Voloshin. George is a director at Aperio Intelligence, a leading corporate intelligence and risk management consultancy, and is also head of their Paris branch. As always, if you enjoy the episode, please do leave us a recommendation on the podcast platform you're listening on. That helps expand the audience and thereby enable us to continue to get great guests for the show. I hope you enjoy the episode. George, welcome to the show.
Thank you.
I'm looking forward to today. We're talking about sanctions, geopolitical risk, and the impact on the commodity markets at large. Before we go too far down that, can you just help us understand, get us all on the same page, what sanctions are in place today on Russia as a result of the invasion of Ukraine?
So I will first start by saying that sanctions have been in place since 2014, so when Russia annexed Crimea. But very interestingly, very importantly, they have never really extended that much to the energy sector, given Russia's leading position as an energy exporter and producer. And although we had some sectoral sanctions in place back then that extended to a number of activities in the oil producing industry, for example, sanctions on special oil projects, as they call them, in the US, which encompass Arctic, shale and deep water projects, they have not been really that much concerned or affected by the sanctions since 2014 and until the invasion of Ukraine this year. So this year, it was really a deluge of sanctions from the Western jurisdictions, which very crucially for the topic of discussion, have been quite heavy on restrictions against Russian oil and gas, coal and metals. So if you look at the restrictions that have been imposed since February, you can see that a number of countries have decided to give up all purchases of Russian oil or gas, or both. For example, you have an effective ban in the US, Canada, and Australia against Russian oil and petroleum products. Again, it should be noted that these countries are not very big clients of Russia. Canada did not import any oil last year, for example, Australia neither. And in the case of the US, the imports have been quite modest in the previous years. It's quite different for the EU and the UK, none of which have imposed any sanctions on Russian oil, but they have made a commitment to impose a phased-in embargo on Russian oil. So in the case of the UK, it's by the end of 2022, at least that's the commitment from the Boris Johnson administration. In the case of the EU, it's quite difficult. Well, I think we'll talk about it later. In the case of natural gas, it's quite similar. So in the case of the US, Canada, nothing. US, there is an import ban. Australia as well. In the case of UK and EU, it's quite similar again. A commitment, but it's a bit difficult because gas is much more important than oil for European consumers. Coal metals, again, some restrictions here and there.
Yeah. So that's the commodities piece, but there have been more broad sweeping sanctions that have meant that picture is a little more complex and challenging, and this leads to self-sanctioning, which we'll come on to. But you've essentially got US government, the G7 and the EU, who have more broadly, as I understand it, taken other sanctions such as preventing foreign investment in Russia, payment methods, etc. Can you just talk to those as well? Because those are very consequential for the broader Russian and all global economies, and also play into whether or not there is a particular ban on a particular commodity, it still introduces complexity and the self-sanctioning piece.
Yeah, of course. So I've only mentioned direct sanctions that really target certain operations with these commodities, but there are also indirect sanctions that, for example, concern the access of Russian affiliated vessels to European and generally Western ports. So there have been restrictions in that space as well. For example, in the EU, they only left some carve-outs for humanitarian goods, agricultural imports and energy. You have sanctions that concern the Russian financial sector, which again have a direct implication for energy sales, because energy, of course, is sold through the formal banking system and you get paid into your bank account. And you have sanctions against Russia's leading banks, such as Sberbank, which has been sanctioned, for example, in the US and the UK, with blocking sanctions in place, but not the EU for the time being. You have sanctions against, for example, Alfa Bank, the largest private loan bank in Russia. So all of that kind of contributes to your ability to sell oil on terms that you previously used. In the case of other restrictions that impact the Russian commodity trade, you can mention, for example, restrictions on insurance and reinsurance. For example, the ban in the European Union, which took effect quite a few days ago, on 15th of May, which prohibits European companies from engaging in activities with certain Russian companies that are state-controlled, including, very interestingly, Gazprom Neft and Rosneft. Again, there is a carve-out for energy, with some very strict restrictions around what is permissible, but this has led to a heavy round of self-sanctioning because many Western companies clearly prefer not to take the risk of breaching any of those sanctions because they're so difficult to understand and navigate. And we've seen self-sanctioning for this very regulatory reason. In addition to self-sanctioning due to moral considerations and the fact of buying Russian oil or gas, which can help Russia to continue its war in Ukraine. This is also a factor. We've seen several companies being unable to unload their cargo at Western ports because port people were just protesting against it and were not really ready to do that job. So again, it's due to various reasons, but sanctions, of course, they're multifaceted. They not only direct but also indirect, and they translate into very severe complications in terms of getting paid, getting your goods out of the country. Many companies that transport goods and they're not able to work with Russia anymore because they don't have insurance cover. So all of that kind of feeds into the general picture we have today.
And just a question on mechanics, and I guess this plays into that self-sanctioning just to understand a bit more. If you were to strike a deal today for delivery, let's say in 2 months, and that deal was perfectly fine with regards to sanctions today, but in 2 months' time, a sanction comes in that prohibits that deal, or let's say a month's time, does that mean that deal is now inviable? Or are these sanctions sort of, I guess, they don't take into account historical deals? Just I know that might sound a bit of a stupid question, but...
No, it's a good question. Well, normally when you have new sanctions that are adopted, they have two very important provisions that actually help deals have been concluded to go forward. So the first of them is a wind-down period, where, especially in the case of the US Treasury, it's a very common process. For example, when there were sanctions against Rusal in 2018, and there were sanctions in place for about a year and a half before it was delisted, there were those wind-down periods normally extended to 90 days, allowing Rusal's customers to get aluminium from Rusal and pay for it. Another important provision, which is again a common feature in all sanctions regimes, whether we look at the UK, the EU, or the US, is to allow deals that have been concluded before the ban to proceed as normal. So, for example, if you have new sanctions in place that start, let's say, tomorrow, they will normally exempt any deals concluded before tomorrow from the new restrictions. So you can potentially get the deal carried out as planned, but you cannot engage in any new deals post the sanctions date.
Yeah. And have we seen organizations, therefore, do long tenor deals to import Russian gas and oil so they would be protected in that event?
So we have seen cases in which, for example, even substantiation also kind of applies to non-Western companies, like companies from China or India. We've seen a number of Chinese refineries, for example, saying that they will no longer conclude spot deals with Russia because they fear just the lack of funding from banks, the lack of insurance. And so for them, it's kind of very difficult in these circumstances, but they will honor their long-term supply commitments. I haven't seen any specific cases in which companies were engaging in long-term deals after the invasion of Ukraine to kind of protect themselves against future sanctions. But you've certainly seen cases in which companies have said very clearly, we will continue to buy oil and gas and whatever coal under long-term deals until they expire, but we'll refrain from any short-term deals because we're not sure of being able to renew them, to roll them over, or of securing funding in these changed circumstances in which banks can clearly just refuse from the outset to participate.
Right. Thanks for that. Okay, so sanctions have a storied history, and not all of it very, effective, if you'd like, in terms of changing countries, organizations' behaviors. Often, well, at least the sanctions in place around the various those countries that have them today, the elites are relatively insulated from the impacts, and it's generally the general population that suffers. In this case, it seems like it's quite, well, it is unprecedented, just the level and unity of sanctions on Russia. Before we talk about the commodities impact, are we seeing, and these do take, and we've all been warned, they do take quite some time to take an effect, but are we seeing the sanctions having any impact on Russia's economy, Russia's behaviors, and then can we walk into what it's doing to the commodity markets? Certainly we know the impact on energy prices and fears and scares in Europe and beyond as a result. But can you just talk about the impact of the sanctions, what you're seeing today?
Yeah, as you said, they usually take some time to materialize, but in this case, they're really unprecedented against the G20 economy. The impact will be very, very painful. It's already beginning to be. So we've seen, for example, predictions regarding inflation, regarding GDP growth. For example, for this year, the Russian Ministry of Economy estimates that the GDP may contract by, about at least 10%, maybe even as much as 14%, which will effectively erase a decade of growth. We have to remember that since 2014, the Russian economy has been growing very, very slowly, below its real potential, and growth has been really under 2% every year. Russia can certainly grow much higher than that because of the lack of interest from investors, because of sanctions that they're impact on specific industries. So in this example that we're seeing today, we're going to have a much more impact on the whole of the Russian economy, on an average Russian consumer. We're seeing inflation really soar. Inflation is soaring everywhere across the world, but in the case of Russia, it will probably be close to 18-20% this year. I think the authorities acknowledge that quite openly because they know it's quite difficult to hide it from anyone. We'll see underinvestment across the board because many companies are withdrawing, also for non-sanctions reasons because they just don't want to be associated with the Russian market anymore. We've seen sales of assets across the entire spectrum of the economy. And the government will not be able to find easy replacements for that. It's very difficult to know how much elites will be affected. Of course, we've seen a number of Russian oligarchs sanctioned by the West and losing access to their assets. Again, we're talking about asset freezes for now. We're not talking about asset seizures or confiscations. Although this is quite possible, these governments are working on plans to potentially forfeit assets from Russian oligarchs to help Ukraine rebuild itself. We've seen some plans for the same with regard to the Russian central bank, whose assets have been frozen in the Western jurisdictions. I think it's very difficult really to understand how much elites have been impacted because elites, they usually have various ways of shielding themselves from the sanctions effects. In the case of Russian oligarchs, they're probably much more exposed than Russian officials because the latter's wealth is mostly within Russia, whereas oligarchs have a global footprint and they have, you also know, mentions corporate assets everywhere. But certainly, if you are an oligarch and you lose a few billion here and there, you don't really become poor overnight. You probably become multimillionaire rather than billionaire. In the case of ordinary Russians, they will probably feel most of the brunt as time goes by because of unemployment. I think just in Moscow, it was an April estimate. The mayor said that the capital could lose up to 200,000 people just because of Western companies withdrawing from Russia, like McDonald's, some car manufacturing plants in the Moscow region, etc. So the impact will be very, very painful indeed.
Yeah. Is there any sense that it's the self-sanctioning? It's quite a nebulous term because a lot of it is actually enforced sanctioning as a result of other mechanisms like payments and insurance, like you mentioned. Is there any sense that that's the more powerful sort of pillar of what's going on here, and that might wane over time if it's not necessarily 100% enforced? Is that anything that you see there?
Well, self-sanction is clearly more powerful and impactful than sanctions themselves because of those who self-sanction, there are a number that do that not for regulatory reasons or legal reasons. They do that because perceptions. So they don't want to be perceived as enabling the Russian government in its war in Ukraine, or they just think that the risk is just too high for them to handle it professionally and effectively enough, and they decide not to invest any more money into managing something that will probably be a very poor return on this investment. So this is a normal reaction, I would say, from the business community, because they just want to cut potential losses and not expose themselves too much. When it comes to future behavior, it's quite difficult really to say how the self-sanctioning story can evolve, whether there will be more of it, whether it will be at the same level as today, or whether it will wane over time, and companies just kind of learning how to live in this new world of even tougher sanctions than before, and probably sticking to what is permissible in the sanctions regulations rather than what is clearly not permissible. It very much depends on what Western governments will do. One of the most powerful tools that the US administration has, for example, is the threat of secondary sanctions. It's when you prohibit foreign persons, non-US persons, whether companies or individuals, from engaging in any activity with sanctioned persons, whether again companies or individuals. For example, you can prohibit a non-European, non-Western company from doing business with Rosneft. We've seen, for example, in 2020, a case in which the US Treasury sanctioned a subsidiary of Rosneft for doing deals with Venezuela's PDVSA, for buying oil from Venezuela. And that was on the basis of Venezuela sanctions, which effectively leave the door open for secondary sanctions against non-American companies. So what happened next is that Rosneft decided to sell those subsidiaries to different people, to different companies, and clearly disengage from the Venezuelan market, because they would not be willing to take the risk of being sanctioned themselves because of that. So if there is this policy in place, it will effectively reinforce the message that the US government is not going to allow this activity in any country. And self-sanctioning may in fact get even tougher than what we see today. So the behaviors are really very difficult to forecast. It very much depends on how the situation goes in general, whether the war ends and what terms, and whether there is any prospect of a political arrangement between Russia and Ukraine and Russia and the West.
Right. Thank you. Okay, so let's just for a moment pause on what are the broad brush impacts that you're seeing on the commodity markets today, and are we seeing organizations start to, is there any sort of element of evasion going on? You know, you've got these sort of cargoes doing these pretty ping-pong-like trips around the Mediterranean, etc. Can you just, but first off, what are the impacts that we're seeing in a broad sweeping sense?
So, of course, impacts are quite diverse. So the first impact is on the price of commodities. Again, we should not forget the general context that we're in with the post-pandemic recovery. Again, pandemic is not really that well managed in some places, and you have China, for example, which has a recent history of new lockdowns in Shanghai and other cities across the country. So it's a continuing story which is taking its toll on the level of demand, which again is something that influences very much the level of pricing across the world economy. And you have this war in Ukraine, which only contributes to high prices. So prices, of course, have gone higher because there's an expectation that Russian oil may, over time, speaking of oil, disappear to a certain extent from the global market. This could be possible if the EU imposed an oil embargo, which is currently in the cards. It's in the 6th sanctions package, which is currently being discussed at the level of European leaders. There is no clear idea of when it will be adopted, if at all. But analysts are also already predicting a progressive loss of Russian oil due to self-sanctioning, due to direct sanctions. And we could potentially see, a loss of maybe up to 4 million barrels per day due to Russia not being able to sell any more oil to its external customers. This is driving the price up. I've seen a few projections by banks. So one bank saying that oil will average $125 per barrel in the third quarter. Another one saying it will be about $130 per barrel. So the general, I think, forecast that oil will be quite expensive going forward later this year. Although I've seen, I think the general forecast for the whole of the year is about $105 per barrel. So the prices have been very heavily impacted. Impacts have been even higher on some other commodities, such as, for example, some metals which Russia exports very heavily. We've seen prices rising for nickel, palladium. So these metals that are also kind of key source of export revenue for Russia. And you've seen that with fertilizers and prices shooting up by 40%, because Russia and Belarus are two major exporters of, for example, potash fertilizers. And some countries like Brazil, Argentina, they need that those imports from these two countries, have traditional relationships with these two countries. So there have been impacts across the board. We've also seen impacts due to supply disruptions because Russia needs to restructure its export routes. And now that, for example, the European Union is no longer allowing Russian steel to be sold in its market, and Russia has to find other ways to sell steel and other banned products to other markets. And so this is also creating a lot of pressure on the price, because if you restructure those export routes, you will certainly get higher transportation costs, high logistics costs. You have to take your goods to longer distances, use other modes of transport that are less economical. So this is, of course, leaving a general impact on the level of pricing. And what we've seen next to that, so probably it's one of the reasons why the prices are so high, is that there are deficits across certain sectors of the commodity market. We've seen, for example, reports of deficits of agricultural goods in certain developing economies, which could in fact lead to hunger strikes, to social instability. So all of that is having a very taking a very heavy toll on the social instability of certain countries in the developing world, so North Africa and the Middle East. So yeah, I think so. Probably these are the key impacts: so pricing, the abundance of goods, logistical problems that cause delays in delivery. You have, countries that are particularly vulnerable have to decrease their imports because they no longer pay for them. The risk of instability in some places. We've seen this playing out at the port of Odessa in Ukraine, where Ukraine not been able to export its wheat, which has kind of been held hostage to the war. So yeah, dramatic situation across the board, I would say.
Yeah. Okay, we'll skip evasion in the we know it's going on, but in the interest of time. Okay, so let's assume that, I think we all assume that this war is going to continue for, if not months, maybe even longer, right? With that in mind, and these sanctions therefore continuing to be in place, potentially more added, I want to talk about sort of what this means for Russia's role in the global markets, its current institutions. The first of which, is OPEC Plus, which played such a crucial role in the pandemic of oil price issues. What does this mean for Russia's position within OPEC Plus?
Well, Russia is clearly going to lose its clout vis-à-vis its partners within OPEC, part of the larger OPEC Plus tactical alliance, which they cobbled together in 2016. It's not very clear how this will play out in the medium term because, for example, while we saw a 10% decline in the Russian oil production in April, Russia is forecasting some pickup in May. So it kind of lost about 1 million barrels in April, and it is expected to recover about up to half of that in May, according to the Russian Energy Ministry forecast. But in any case, Russia's position is not particularly convenient or stable, and Russia is clearly going to become much less important, relevant for OPEC Plus than it used to be. For now, Russia's key partners within the alliance, Saudi Arabia and the UAE, have been sticking to this relationship because they clearly understand that without Russia, OPEC Plus will be even less relevant. But it's if Russia's position is going to shrink further, which is likely to happen because I don't think that sanctions will be lifted anytime soon, and so this story will probably continue into next year. And well, we'll see what happens next. But the current forecast that I have is that effectively Russia's position will dwindle further. And Saudi Arabia, I think I saw some announcements from Saudi Arabia saying that it is planning to ramp up its production considerably by 2027. It's already pumping a record amount of oil, if you look at the past 2 years, and it probably going to move closer to its record set in 2020, when it was pumping close to 12 million barrels per day at the height of the price war with Russia over quotas. So I think Russia is going to really lose attractiveness and appeal and importance within OPEC Plus, and especially if the Biden administration finds a way to accommodate the positions of Saudi Arabia and the UAE, what it's now trying to do, mend fences with those two jurisdictions. In this case, Russia will probably be even more isolated.
And it's also having further consequences in the Biden administration's approach to Venezuela and indeed Iran.
Indeed. So it's quite interesting because we've seen in the past week an announcement from, no, it's probably rather the media reporting that, but the White House was not really trying to deny any of those stories. The Biden administration has given a license to Chevron to potentially restart some operations in Venezuela with a clear view to easing the oil price. I think this is not really a very easy move because of the Republicans' very anti-Maduro stance, and they effectively criticize the Biden administration for trying to accommodate the Maduro administration with this move. But Biden, I think, his team clearly understands that they need to take some steps to alleviate pressure on the price of oil, which translates into high gas prices in the US. And with the midterm elections cycle approaching in the US, the position of the current administration is not really that solid. In the case of Iran, it's much more complicated because there is this discussion going on with the new Iranian president about a revival of the JCPOA agreement of 2016, which was effectively killed by Trump when he withdrew the US from the deal in 2018. It's very unclear whether this deal will materialize in a different format because of Iran's reluctance to make any concessions to the US before the US lifted sanctions. There are a few blockages around the status of the Iranian Revolutionary Guards, which are heavily sanctioned in the US and which also are on the State Department's list of foreign terrorist organizations. If there is some movement there, we'll probably see some willingness to engage in a new round of discussions and reach a compromise, but it's all very, very uncertain. And of course, there are parallel talks between the US and Saudi Arabia. It was just a recent announcement that there could be a visit by Biden to Riyadh for the GCC Council where he could meet the Crown Prince and potentially reestablish an old relationship with Saudi Arabia. All that with a single objective in mind to stabilize the oil market and to bring more oil online.
Yeah, Mr. Putin's done a lot for world unity, hasn't he? I think much to his dismay. But okay, so we've done a lot on the European energy crisis and the sort of the role of the Russian sanctions in that. So I just want to zoom in on just one aspect, which is natural gas. Do you see growing unity around an import ban? Do you think the EU can solve, therefore, that deficit in this upcoming winter through LNG?
I would say that gas trade is the most complex issue on the European Union's agenda when it comes to Russia. So it's really an area in which there is probably no unity at all. So it's something that is been tackled with a lot of vigor by the European Commission, trying to find compromises between member states. It's difficult to reach consensus on the oil embargo, and I think given that Europe is much more dependent on Russian gas than on Russian oil, it will be much more difficult to envisage anything short-term in terms of gas trade. Of course, it will be impossible to replace Russian gas in the short and medium term. We're just talking about, extremely high volumes of gas flowing from Russia using the Gazprom's pipeline infrastructure, so what it ships to Germany, to Poland for Belarus, through Ukraine as well. There are already discussions underway about buying more LNG, and we've seen Germany making an outreach to Qatar to import more LNG from Qatar. Germany is trying also to reinforce its energy independence by planning to build 2 LNG terminals, whereas it has none compared with other member states. It's a very long-term issue, I would say, and this winter will probably be a time when we will see the real effectiveness and solidity of European unity, whether Europe will really present a common front against Russia. How Russia will react is also a major problem. So far, we've seen reports of European companies, really trying to comply as much as possible with European sanctions, but at the same time, not being ready to risk their relationships with Gazprom. And if we talk about this controversial decree by Putin, which kind of switches the currency of gas contracts from euros and dollars to rubles, According to recent reports, about half of all European consumers, importing companies, have switched to rubles. So have put in place mechanisms to be able to pay in euros, dollars, and then in rubles. This shows the complexity of the whole situation. I don't think the European Commission will have enough authority, enough power, because we're talking here about hard economics, to convince member states and their key importers to comply with sanctions 100%. So we have to be a period of transition with concessions being made by the European Union, and Russian gas will remain for the time being the major source of imports as far as Europe is concerned.
Thank you. Okay, so before we sort of come full circle back to the narrative of deglobalization and whether that's real and what that means for this sector, can you also I just want to talk about China and in India. Is this ultimately a boon to those countries who are net importers of energy, and suddenly they've got a cheaper source in the Russian markets now because there's less competition for that energy?
Absolutely. I think both countries have been taking advantage of the self-sanctioning narrative that's been playing out since February. The sanctions regulations have been becoming increasingly tough and strict. So we've seen reports of India, for example, buying Russian oil at heavy discounts, up to 30%. China trying to negotiate convenient pricing for itself as well. These two countries are clear winners of this situation. That said, it's important to bear in mind that those countries are also vulnerable from the point of view of sanctions, and so we've also seen some self-sanctioning by Chinese and Indian importers, like refineries or state energy companies, have been really trying to navigate the complex landscape we have today with a lot of caution. But speaking of potential trade evolution between Russia and these two countries, effectively India has ramped up its oil purchases considerably compared with pre-war periods. And we know that it's paying much less than what Russia would like to get paid. It's insisting on very heavy discounts. China also is trying to fill its reserves with more Russian oil. And I suppose that, although the price of those purchases is probably buying oil at very heavy discounts too. So these two countries are clear winners. The next question that comes naturally on the table is what will happen from the perspective of Western governments. If Western governments, especially the US, decide to try to deprive Russia of its access to oil revenue, they will have to tackle the issue of secondary sanctions and Russia's relationship with India and China in particular. And we have to drive this point home that these countries should stop buying Russian oil, or stop buying as much Russian oil, as happened in the case of Iran, for example, where even China, which always criticized US sanctions and tried to strike an independent line of conduct, even China back then pulled out from all of its projects in Iran, and really, if there was any oil bought, it was bought using evasion schemes by very small refineries that were not really associated with CNPC or key energy players. So the future of this trade is uncertain, but for now, these two countries are clearly winners of the situation because they can buy oil at heavy discounts, and they've been doing that very openly.
We've seen sort of mixed messages from China, at lesser extent India, about support for, or at least their views on Russia's invasion. Do we have any sense of whether they're increasingly accepting of it or they're applying pressure just through non-public channels?
Yeah, I think that both countries are pretty worried about what Russia has been doing in Ukraine. I think China is particularly uneasy about Russia's choice to initiate this war. We saw, the meeting between Putin and Xi in Beijing before the war, where Xi said that the bilateral cooperation had no bounds. It was going to develop very actively across all the key areas of mutual interest. For China, this war is really a big distraction. China is also concerned about whether it could be, held accountable for keeping a good relationship with Russia, as if it was providing support to the Russian economy to evade sanctions, to evade these restrictions. I think China is trying to convey its position publicly through diplomatic channels, through private channels. It's been very cautious since the beginning of the war, although we've seen also some open criticism in the Chinese press, very interestingly, not from current officials, but from former officials who retired. But he would never have allowed themselves to express this position without, I think, some either encouragement or at least a promise of no retaliation from the Chinese authorities. So I think both countries are really very worried because this war is having implications for everyone. Again, it could potentially accelerate recessionary trends in a number of countries, a number of economies, including the US. And so it's not really a good thing for China, which is a major exporter, and India, which depends on energy imports to a very significant extent. Like, for oil, it buys 85% of oil. And for India, really, the main risk is not so much whether it can buy Russian oil or not Russian oil, but rather the level of pricing it gets from its partners. So both countries cannot be happy with what's happening. And I think, especially China, they're trying to convey this unease to the Russian government privately.
Yeah. Okay, thank you for that. So let's talk about deglobalization. And in fact, I attended a lecture this week by a leading economist and senatorial hopeful, where he described the world potentially going down a two-system route, where one which is dominated by the US and the West and its trading partners, and another that is dominated by China and its trading partners, which would have profound consequences for prices, global free trade, and the commodities sector. Where do you and Aperio stand? Are we in a moment of deglobalization? The individual mentioned that we might be looking back at the 92 to 2022 period, those 30 years, as a period of, he described it as global complacency, but a period of sort of a golden age of global free trade. Where is your views on that?
Yeah, it's a very topical and also complicated area. I've also listened to a couple of your own podcasts where people were discussing this issue, and I think everyone has different opinions about globalization, whether it's real or it's just in a fiction, in what direction we're going as a global economy. Well, I think we're clearly seeing some deglobalization trends playing out, which are not necessarily due to the Ukraine war, but rather, they began with the trade wars that, for example, Donald Trump launched against China. His commitment to making America great again by bringing back production from certain countries in which it was historically based. So this discourse, kind of nationalist discourse, protectionist discourse, is quite the main driver of these trends. And then we saw the pandemic, which made clear to everyone that the current system that we're in is not necessarily the most reliable, and in many cases, when you have production based elsewhere, you could become dependent on those countries and their ability to ensure production and exports. And if there is a huge crisis like COVID-19, this becomes a real problem. And so many countries have been trying to onshore foreign-based production to the extent possible, even at the cost of higher prices and higher cost of labor. I think I would probably agree with this assessment by this lecturer you mentioned, that there will be two global kind of trade zones, one dominated by the United States as the world's largest economy, where the Western camp being there, of course, and US allies across the world, like Japan, Australia, New Zealand, all coming together to make this happen. And then another bloc dominated by China, the world's second largest economy in terms of purchasing power parity, and all the key players gravitating around China, including Russia. So Russia is clearly going in the other direction. It's going to be dependent on China in many respects. I think this is a good assessment of the situation. I would say that deglobalization is probably too strong of a term for the current period. So we're still in a world which is very heavily globalized. But what we'll see is that we'll see an emergence of regional blocs and sub-blocs where trade will be easier and that it will be difficult with the other blocs not part of the same trade alliance. And this will effectively divide the world into with China being the second pole of attraction for developing economies and those who are not aligned with the US geopolitical interests.
Yes, he also mentioned that switch from just-in-time economies to just-in-case economies, which ties back to that onshoring of supply chains and inevitably increased prices. So the commodities industry, at least my tenure in it as a recruiter, has thrived in those 30 years of either global complacency or a golden age of free trade, whichever you pick your poison, in its ability to optimize the global commodity supply chains. And, we've talked throughout this episode, fertilizer from Russia going to Brazil, etc. What does this mean for the commodity trading industry as they navigate sanctions today, and presumably more sanctions coming, as they navigate deglobalization? I mean, organizationally alone, how should commodity traders, commodity trading entities prepare themselves for this new normal?
So they have very difficult tasks to do to be prepared and stay prepared in the future. So again, as you said, geopolitical complexity is something that has been taken for granted for many years. The world is globalized. Even when I look back at the Russia sanctions, the first ones from 2014, we look back at the Venezuela sanctions, there was a period of time in which I think commodity players, like the big commodity trading houses, were all kind of complacent about what Western governments could potentially do to disrupt their business models. So even back then, it was kind of assumed that trade will continue because it's vital to the world global economy, and that you have to comply with sanctions, of course, you have to do it from a very strict legal point of view, but you are not obliged or asked to do anything beyond that. It's a bit different today. In the case of Russia, we've seen major companies like Glencore, Vitol deciding not to buy any more crude from Rosneft, for example, because of EU restrictions, which, if you look at them very legalistically, they don't necessarily prohibit trade between Russia and the EU from Rosneft, from Gazprom neft, but they do create a lot of complexities and complications for companies to operate normally. So companies, again, preferring not to risk their reputations and just discontinue their operations without any extra work. So I think in this climate, companies will have to be very serious about geopolitics. They have to look out for any geopolitical developments, very careful about what would happen realistically to them. So do a bit more horizon scanning for new trends. So you have task forces that can easily gather to analyze the situation, how it's developing, what are the impacts for their business. They have to be very serious about compliance and legal. So compliance is really an area which is gaining in importance and relevance. It's something that's increasingly important, and sometimes it even outweighs commercial considerations. You have to be really very, very serious about your compliance obligations and compliance expectations of regulators across the world. I think, deglobalization is certainly going to have a variety of impacts on these various companies. On the one hand, higher prices are a boon for their business. On the other hand, as the world gets more compartmentalized, their role becomes diminished. And so it's very difficult to know what will be the trade-off, whether we'll lose more than they will gain. Also, we should not forget about renewables. Renewables are also part of our future, and renewables are effectively a factor of deglobalization, which can make the importance of these trading houses even less relevant, because less energy will have to flow across borders. More will be produced domestically through renewables, various renewable technologies. So all of that will have an impact. I think, speaking of today, so companies need to be very vigilant about short-term and medium-term risks, and also do some contingency planning, horizon scanning, to understand where geopolitics is headed. It's very difficult. It's probably the most difficult exercise that you can ever do. Plan for the future for maybe 20, 30 years ahead. Try to understand where the new trends will be in 10 years' time. But it's important, and these companies have to engage in this thinking as well as any other company operating internationally.
Are you seeing, again, a lot of this is kind of new and quite sudden for this sector? Of course, historically, they've always had to be compliant. There's been growing compliance requirements, growing transparency. But are you seeing these organizations thinking about, from a personnel standpoint, are you now needing a head of governmental relations, whatever it might be, I don't know what the title would be necessarily, but being organizationally set up to map, to process and digest all of this very fast-moving, regulatory, geopolitical, sort of disrupted world?
Yeah, absolutely. I think if you look at the number of people employed in compliance and legal by various companies, banks, insurers, and then corporates, and look at trading houses, I think the preference has always been to have more people dealing with pure risk management. So trying to mitigate your trading losses, which based on volatility, pricing, etc. Not really that much invested into having more compliance and legal people. So this is going to change, I think, also require input from people who understand geopolitics, understand political affairs, not only within a given country, like we do for GR. We're trying to see whether the government is going to change its taxation policy, for example, whether it's going to take a different stance towards domestic oil production, but also thinking about larger trends that cross the borders and trying to see whether specific countries will be disadvantaged by certain global trends that they are not necessarily concerned about directly, but they will impact them indirectly. So I think, there's a clear need for people who have a good, solid understanding of legal risk, of compliance obligations, especially sanctions, because really I think for those companies, corruption and sanctions are two main risks that need to be managed. And we've seen cases in which companies have been, found guilty of corruption increasingly, and sanctions effectively are an area of a growing complexity, growing concern. But also, in addition to that, people with an understanding of political risks and how they impact your business in every possible way. Yeah, clearly there is a need for those two types of people.
Yeah, because I think that's the difference, isn't it? I mean, certainly we've seen organizations build and grow their compliance and legal capabilities in-house, but it's really that element of political risk now where, you just, around the world, like you've got a consequential election coming up in Brazil that could entirely change the last 6 or 7 years worth of liberalization in those energy markets. Right? I mean, just the complexity today compared to maybe 10 years ago when we all thought there was just a forward march of liberalizing energy and commodity markets is astounding. I assume you at Aperio have seen a significant rise in demand for your services.
Yeah, absolutely. We have many clients worried about the future of their supply chains, for example, trying to restructure them in ways that will make them more resilient in the case of a next health emergency like COVID. Also, many companies trying to be more vigilant and more prepared for any contingencies involving their foreign operations. For example, there is instability in certain region in which they operate, how they should react today to make their operations more resilient and their business more less vulnerable to politically induced negative developments like disruptions. Certainly, so I think these skill is very important in the world where politics has become so toxic, divisive, and where we're seeing a much more rivalry today between great powers, between regional powers, than in the previous decade. So it's really a world of of great instability for many years to come, in which we have to live and be prepared for any contingencies.
May you live in interesting times, as the Chinese say. It's definitely the landscape is changing. Well, I think you've given a demonstration of how we've just scratched the surface of this topic, but you've given us an excellent overview of what's going on now and how this is going to be an important trend and topic going forwards. And I do look forward to having you back on in a year or so, and we can get an update on how these things have played out. It's a very consequential moment for the world and also the commodity markets themselves. And yes, the challenges ahead are mind-boggling for these organizations to navigate. But George, thank you very much for your time.
Thank you very much, with great pleasure.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.